Hey everyone, and welcome back to the channel where we demystify the complex world of finance, one stock at a time. Today, we're diving deep into a fascinating, high-octane corner of the market, hard-to-borrow stocks and the potential for a short squeeze. Our spotlight stock for this unique case study is BIYA International Group Inc., trading under the ticker BIYA. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about BIYA. BIYA International Group Inc., through its subsidiaries, operates in the technology/software application sector. Based in China, they provide essential human resource services like job matching, entrusted recruitment, project outsourcing, and labor dispatching for businesses. They also handle crucial functions such as human resource management, payroll advances, electronic contracts, and pay slips. Currently, BIYA holds a market capitalization of around $119.02 million, putting it firmly in microcap territory. Today, this stock has seen explosive movement, up an incredible 116.6%. Over the last 5 days, it's gained 34.95%, although looking at the last 30 days, it was down 37.57% before this recent surge. Show chart BIYA 1-day, 5-day, 30-day performance. What is cost to borrow and why it matters? So, what exactly does it mean for a stock to be hard to borrow? When investors want to bet against a company, they borrow shares and sell them, hoping to buy them back later at a low price to profit from the difference. This is called short selling. Just like any loan, borrowing shares comes with a fee, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. When a stock is hard to borrow, it means there's very little supply of shares available to short, and the demand to short them is high. Consequently, the CTB fee skyrockets. A high CTB is like an alarm bell signaling intense short interest and a scarcity of shares. Why this stock is hard to borrow right now? Now, why is BIYA appearing on our hard-to-borrow screener? The numbers speak for themselves. The cost to borrow fee for BIYA is a staggering 773.1% annualized. Highlight CTB fee. Think of that: if you held a short position for a full year, you'd pay over 7 times your borrowed value in fees. This indicates an extreme scarcity of shares available to short sellers. The estimated float, which is the number of shares readily available for public trading, is a tight 2.7 million shares. Our internal composite squeeze score, which factors in CTB level, borrow supply, float size, and price momentum, currently sits at 51.0 for BIYA. This combination of an exceptionally high cost to borrow and a relatively small float makes BIYA a prime candidate for our hard-to-borrow discussions. Squeeze mechanics explained. So, what happens when a stock like BIYA becomes this expensive to short, especially with a tight float? This sets the stage for a potential short squeeze. Here's the simplified version: short sellers are obligated to eventually buy back the shares they borrowed. If the stock price starts to rise, driven by buying demand or positive news, short sellers face increasing pressure. Not only are their positions losing money, but they're also racking up those hefty 773.1% daily borrowing fees. This can force them to cover their positions, meaning they buy back shares to close out their shorts. This forced buying creates even more demand for the stock, driving the price up further, which in turn forces more short sellers to cover, creating a powerful feedback loop. It's a cascade effect that can send prices parabolic in a short period. Dilution risk check. One crucial aspect we always assess when evaluating potential squeezes is dilution risk. Dilution occurs when a company issues new shares, increasing the total share count and reducing the value of existing shares. For a short squeeze, dilution can be a killer, as new shares can absorb buying pressure and negate the scarcity needed for a squeeze. For BIYA, we've performed a thorough check for recent dilutive SEC filings like SMINUS1s, SMINUS3s, or 424BS within the last 90 days. We found no recent dilutive SEC filings for BIYA International Group Inc., which is a positive sign from a squeeze perspective. Recent reverse split watch. Now, something critical to note for BIYA: the company executed a reverse stock split, 1-4-10, just 14 days ago on July 13, 2026. A reverse split reduces the total number of outstanding shares and consequently shrinks the float, making each remaining share more valuable on paper and resetting the share price higher. While it doesn't change the company's underlying fundamentals, many microcap stocks historically tend to see renewed volatility or a price pop within about a month after a reverse split. This isn't a guarantee, but it's a pattern we've observed in some names, and BIYA's recent price action could be reflecting this tendency. Before we go further, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with BIYA? With its current 773.1% cost to borrow and a tight 2.7 million share float, the conditions for short squeeze potential are certainly present. Today's volume data is telling 87,912,100 shares traded today compared to a 30-day average of just 8,792,792 shares. That's a relative volume of 10.0x the average. Highlight volume. This incredible surge in volume combined with the plus 116.6% price jump suggests significant interest and buying pressure. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have strong conviction in their bearish thesis and are willing to pay significant fees to maintain their positions. Key indicators to monitor would be continued high volume, sustained price momentum, and any further reduction in the number of shares available to borrow. BIYA International Grouping, or BIYA, presents a compelling case study for understanding hard-to-borrow stocks and the mechanics of a potential short squeeze. Its extreme costs to borrow, tight float, lack of recent dilution, and recent reverse split, combined with today's explosive price and volume, make it a stock to watch purely from an educational standpoint. Remember, investing in these highly volatile stocks comes with significant risks. Always conduct your own thorough due diligence. If you found this breakdown of BIYA's hard-to-borrow situation helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments if you have any questions or other stocks you'd like us to explore. Thanks for watching, and we'll see you in the next video.